while access to savings account or bank accounts have gone up, access to credit remains elusive for a large part of the world population. In India, TransUnion estimates that about 820 million Indians are either underserved or unserved when it comes to access to credit. The challenge is to be able to provide credit to these individuals, banks need to assess whether they have the wherewithal or means to pay back this credit, what we call credit risk. Now, these are people with limited, thin credit histories or no credit histories. So, if you don't have a credit history, you're stuck in this loop where you can't take a loan because you don't have a credit history, because nobody gives you a loan, you can't build a credit history. The RBI governor recently announced a new lending platform called Unified Lending Interface during the Global Fintech Festival. The whole idea behind open banking is that one, it can increase competition in the financial services. As competition increases, there may be more innovation when it comes to financial services, and innovation can lead to better welfare for consumers. A second aspect is that it allows new entrants to come in and expand access to credit. Now, this is what is more relevant for developing economies, the access to credit part. So, the key difference between ULI and an individual bank is, now when a customer applies, that application is relayed to multiple lenders. The challenge is that the rate of disruption is very fast. So, the government is in some sense building this expectation that going forward in the fintech space, it will be quasi-government bodies that will keep innovating. But that innovation has a cost. It is at least partly being underwritten by taxpayers today. Maybe 2 years or 3 years down the line, innovation should be coming from private enterprises, not just government body. So, it's not like there was no expansion of credit on that front. ULI just makes it more seamless and it increases competition across multiple banks. It also allows smaller lenders to not have to innovate or invest in technology, but they can do plug and play. They can use ULI's API and start entering the market. Maybe earlier some of these lenders would have found it very costly to develop their own technology. Now they can use the API offered by United Lending Interface. On the other hand, some players like Google Pay, for instance, who are building sort of their own lending platform where you can apply for a loan and they would relay this loan demand to multiple of their banks or fintech partners, that may get disrupted. So they may lose out in the process. Now it is possible that they will latch on to ULI just like they latch on to UPI. They may find other forms of monetizing this, maybe by cross-selling insurance or investment products. But who is to say that RBI or SEBI or any other body may not come up with a unified investment interface tomorrow and disrupt that? So the broader point is that while this innovation is generally good, we also have to worry a little bit about the implication of this for incentives to innovate in the private sector. There is an optimal rate of innovation, there is an optimal degree of competition as well. A very fast rate or a very highly competitive space can also kill profits and consequently entry of business or the business model itself. So while we innovate, we should at least be considerate or at least consider some potential implications for this for the broader industry.